Okay, so now we're going to move on to part three. So in part three, we're looking at sort of just the macro outlook and my expectations. Just remember, this is all just purely my expectations. Okay, so where shall we start? So the data. So, that data that's coming out continues to look more promising. I would say, except for manufacturing, which is still just the sort of the laggard. It's not a great performance from manufacturing so far. But then, the question is it because there's less demand coming through now, or is it just because, they built up such high inventory that they're still running that down? Moving on to inflation. So inflation remains the key topic and the key focus, obviously, for central banks. And although it's moving in the right direction, I still see there could be a couple of bumps coming up very soon, especially just around the time of the next round of central bank meetings after their summer recess. Now, demand remains fairly strong. But really for me, my main concern is more on commodities. If you look at WTI, it's traded back over $84 last week. And then, of course, there's still that potential for agricultural products to spike if Russia and Ukraine sort of escalate their attacks on the ports and ships. Now, something else to sort of bear in mind is this extreme and unpredictable weather that we've been experiencing around the world. And again, that could add to supply issues. You could see more countries either reducing or banning exports. I mean, just recently, India banned exporting its rice. And of course, again, that sort of reduces supply and that's going to sort of potentially increase prices. Now, reports show also that there is an increase in demand for oil, and that's hitting just as supply cuts from OPEC and the Saudis start to really impact the markets. And then on top of that, of course, even more pressure for oil could come from a weaker dollar. It's stabilized at the moment, but if it can, if the dollar was to have another slide again, that puts price pressure to the upside for all commodities, really. So it has sort of this inverse relationship with commodities, the dollar versus commodities. So if the dollar is going down, then demand for commodities tends to increase, and that's because it costs, it takes less of your local currency to buy those products because the majority of them are priced in dollars, and that's what adds to the demand, just in case you wasn't aware of that. Now also, we've seen that gas spike up last week because there was threats of strikes in Australia. And of course, I think at one stage they was up something like 30%. So again, just keep an eye on that. All of this, grains, the commodities area is something that could really sort of give a little surprise kick to inflation on the upside. Now, when we thought it was gone in the rear mirror, disappeared forever, COVID is making a little bit of a surprise comeback with a new sort of version of it called Eris, and those cases are rising. It's a new version of the Omicron variant, but it's spreading, so hopefully we're not going to sort of see a massive new cases everywhere, because it's just nice to think it's gone. And when you think about all those lockdowns, they just seem so long ago now, don't they? Okay, so geopolitically, we've got to look. Biden claims that China's economic problems could be a ticking time bomb. It is possible, I suppose. They've not invested just in lots of other countries, but they've got massive issues, especially around construction in their own country. And it's not something that the world would want for sure. You wouldn't want to see the Chinese economy explode for sure, or implode. Now, he's also not helping because he's adding new rules on investments into China. Whether he's trying to protect investors or whether he's just trying to hold China back a little bit, you have to make up your own minds. But China is committed to adding support to the construction industry and in general stimulus to the whole economy. But the problem is, the question really is, can they? And if so, by how much? They just don't seem to, I mean, if you go back sort of after 2008 when they really sort of took off their economy, it was a great time for the world because it really boosted demand at a time when it was being destroyed. This time round, I just don't think they've got the same ammunition, that same buying power that they had then. And of course, part of that has been caused by their construction, their building industries. They've got complete towns or maybe even cities that they've built but are left unoccupied. And of course, they're trying to fill those and for those houses to be sold. And it's strange because, in other countries, I'm in the UK, so definitely in the UK, for example, there's such a shortage of residential properties. And that's even when there's less than 8% of the land mass being used for for residential properties. So, I'm just amazed that we're not sort of expanding out. We try and force more and more people into the same space rather than building new towns and cities, which, again, would generate jobs. So why they're not doing it, I really don't know. But also it is a contributor to inflation because, of course, we've got those higher rents. And that's been a major impact on inflation in the US and, of course, other countries as well. So global trade is still contracting. We're seeing that by China's poor trade data last week. Manufacturing still under so much pressure. Surely it must be time that it starts to improve soon. I suppose a lot of that's going to depend on if or when there's recession. Now, if there is a recession, again, it's going to be different in various countries. But we're seeing that unemployment creeping up. There's fewer new jobs available now, and there's potential that could pick up pace as we come towards the end of this year. It's possible the US could still manage a soft landing. That's purely going to be from the amount of stimulus that they put in over COVID, I would say. And, I'm just not sure that Europe or the UK will be just as lucky as that. Just in general. Especially, if commodity prices start to go up again, then that's going to be problematic. Or, of course, last winter we were very fortunate it was mild. If we have a harsh winter this winter, again, that's going to become inflationary. Something that does surprise me is French unemployment. It's rising. It's at 7.2%, which is much higher in comparison to the likes of, say, Germany and the UK. And sort of just talking about the UK, data coming out from there last week was better than expected. GDP actually improving. This week we're going to see wages and inflation data coming out. And again, that's going to give a little bit more insight probably into what the Bank of England's next move on rates is going to be. I suppose, the thing that's maybe just sort of going to keep them under pressure a little bit, not to hike rates too much, is that sort of house prices are still coming down. And of course, inflation is still too high as well. Now, central banks The fortunate thing I would say at the moment is that because of the summer recess, that central banks will see a little bit more data to bring in before they have to make those rate decisions in September. So that's pretty much it for the macro outlook at the moment. So there's not too much that's changed. You know, it's still all about inflation, isn't it? But you know, just be aware. Just you know, the points that I've made here about that it could have this little turnaround between now and September, October, just due to commodity prices. All right, so now we're going to take a look at a few charts for a variety of different asset classes. So hopefully you'll stay with us for part 4. Again, here's our services. I'm not going to bore you by going through them in every part. So they're there. If you need us, we're available and we'd love to help you.